right. Welcome back. We're
Yeah.
missing one crew member.
Mm-hmm.
She's on
Yeah.
her little vacay to Austria.
For sure. Hopefully it shows a train wreck with
Although
her
I
gone.
didn't get the picture up. I didn't have
Next
that-
week.
I didn't have that ready in time.
Well,
so
we'll get it
Yeah,
kind of a
we'll-
collage where
yeah.
she's, got 3
there
or
we
4
go. That's
drinks
what we'll do.
Yeah.
Yeah.
in her hand.
Yeah.
Right.
All right. Perfect. Episode 58. Keith, Kyle, Tyler. We'll stick with our 2 truths and a lie. So for 58, the atomic number for cerium, I think that's how you say it, is
Yeah.
58.
Mm.
Super Bowl 58 was played in Las Vegas for the first time ever. And the Eiffel Tower has exactly 58 floors.
Kyle, you want to take a stab first at
You're
this
trying
one?
to buy time?
Yeah, I am.
I've been to the top of the Eiffel Tower.
Oh, you have?
It's been some time, but
Did they have 58 floors?
I don't remember. I think it was. So I'm going to say that one seems right. There was a cool elevator that you flip up.
Oh,
to
so
the
you
top.
didn't walk
We,
58
you,
or
you don't
57,
walk the
whatever it
entire.
was.
Yeah,
Okay.
we're not living in the 1940s anymore.
right.
Yeah. I'm going to say A is not correct because I'm pretty sure last week or whatever, the beryllium or whatever it was
Yeah,
the fake.
I'll go. The Eiffel Tower has 58 floors. That sounds about right to me. I mean, I look at it and it looks like 58. Like I know. Super Bowl 58. I think that is true that Las Vegas was the first time ever. Was Tyler's doing a 58, 57 number on us? I don't think so. And then we always throw the atomic, chart in there, which I'm not sure why we do that since none of us are scientists and don't know any numbers. So
I'll be honest, this was just ChatGPT giving me the...
I know.
Oh,
it
really?
It
Nice.
throws exactly. So I'm gonna say that one's false as well. So Kyle and I are on the same boat.
All right. It's actually C.
Dang.
What the
So
hell you been there, Kyle?
Yeah. The Eiffel Tower technically only has like 3 observatory floors.
Right.
But then there's a restaurant called like 58 Eiffel something on one of the observatory decks.
Did you at
Okay.
least hit that when you were there?
I honestly don't remember. I've got great photos of like the landscape, but I don't remember.
Would you recommend seeing the Eiffel Tower?
Oh
or
yeah,
not?
it was incredible.
Okay.
Yeah, it was really cool.
All right.
Sweet. But before we get into Hot Button, I do want to just have Kyle give us a rundown of his new portfolio that he is taking over.
For sure.
Yeah.
I guess it's not a new, I
New
guess
to me.
New to
New-
you, but
new-
also kind of a
reworking.
a change in philosophy a little bit. So
Mhm.
why don't you give us a little breakdown on the new Contrarian Choice portfolio?
Yeah. So we are revamping this. We're taking it to a very deep, story-driven stock pickers portfolio with compelling theses, catalysts, risks. So basically looking for companies with material, hair on them, big pullbacks, mismanagement, lack of innovation, out of favor stocks, whether it be the business cycle, any of that kind of stuff. So we're looking for those beat up names that are in general higher quality with clear catalysts to recover. So you can think of traditional kind of deep value, low PE multiples, price to book, cash flows, just things that are beaten up and looking ugly, higher dividend yields for sure. But again, higher quality, good, strong business that are just kind of down and out.
So give us an example of a name or two that is that you just introduced into the portfolio.
Yeah. So we had a big bout of turnover last week when we added the new names, but going forward, 10 to 20% turnover is going to be kind of normal, expected. And some of the names that are in there now would be like a great example, Dollar General. Yesterday,
oh, nice.
Yep, that was in there. Historically, really, really great business, strong return on invested capital. If you've owned it for 20 years, even with the last 2 or 3 of high inflation and kind of that beat up name where it's really kind of cut in half, a little more than that, but you've still generated a really strong investment return. So with inflation subsiding and the consumer kind of settling a little bit, we're seeing them continue to invest in store growth and renovate and upscale that experience. and still be there for the consumer. So they are one of the very, very few. You've got Dollar Tree, which reported this morning poor looking numbers. It was not good for them. But the number of SKUs that are actually targeting that kind of $1 mark are vanishing quickly. And Dollar General is investing in supply chain, doing the right thing, even though it's painful in the short term. In the last 2 years, it's been tough for them, but continuing to invest to innovate and grow those margins and the business over time is really what we're looking for. And other names would be like Huntington Ingalls, so the sole builder of the U.S. aircraft carriers and the ballistic submarines. So people don't really think long-term secular growth. Like, they've had some labor issues where they didn't include inflation riders in their labor contracts for building these huge.
Nice.
That's a problem.
Yeah, it's a problem, right? So that kind of bond-like business, because it takes, it's a decade contract that you get these things, and it takes 10 years to build an aircraft carrier or more in some instances. And then they're online for 30, 40 years. And so just right-siding the ship, if you will. I mean, the Department of Defense is targeting $160 billion to aircraft carriers, submarines, and destroyers in the next decade.
Wow.
And
Big
they are
number.
the sole producer of that. And you've got General Dynamics that does some of it. It's like about half their business with Electric Boat. But Huntington Ingalls is the down and out. They had some unfortunate mistakes with contracting and inflation riders and that kind of thing. But now that that's behind them, they're starting to pick up some steam. And those are some of the names that we look for, where it's like really interesting, good businesses historically, down and out for maybe 2 to 10 quarters, but new management teams come in, or there's a clear catalyst, a cyclical recovery that can help drive those things. So
Yeah, and that's when the stock can really perform, right? You can get, stocks that go up 50, 100%
Right.
plus over, a length of time. So that's
Right.
kind of why we're doing it. So
Yeah.
yeah, we're excited to see what you can do with it.
Well, and on that note, with some of those deep cuts in the portfolio, it's for a longer term time
Investor.
horizon for that investor. You're going to have more volatility. You can have periods, because all those catalysts don't pop at once. So you kind of have to, it's like cayenne to
Take the good with the bad.
Yeah, right.
Yep.
You add some to the asset allocation, but not the full thing.
Yeah.
Right.
Sweet. Love that. All right. Hot button topic for today. So both my topics we touched on a little bit last week, but I'm just really curious about this and your guys' thoughts. But if we look at this rebound from the April 8th lows, over 50% of that rebound has come from the top 10 or the top 10 names in the S&P 500. I mean, NVIDIA's accounting for almost 12% of the overall gain that we've gotten off of the lows. And so what my question is this performance, like, once all of these sellers go away of these things, are we going to continue to have these V-shaped like recoveries? Because people are just investing in their 401ks, they're just buying index funds. And so the largest companies continue to benefit. And there's not like a catalyst for these companies to have this significant rebound, or the catalyst for the market to have this significant rebound.
I'll start with that. Just because they're the biggest doesn't mean they're always going to remain the biggest. It ultimately, I think earnings drive stocks. What you saw recently, I think those earnings, those Meg 7, or like you like to refer Meg 8, Broadcom in there as well.
Heck yeah.
Those names have been fantastic. They were better than expectations. I think that's why you're seeing them rebound and kind of leading this recovery. And if you go back last couple of years, their earnings growth rate outpaced the rest of the market. So if you look at those top 7, 8 versus the 493, the growth was a lot higher. You get a higher PE multiple. They drive performance. They're the big guys, so that kind of helps push the overall market. What you saw in the correction time is people were worried about their growth rate was slowing. Still was going from 25 to 15%, potentially down to 10. Whereas the other group, that 493, was negative earnings growth rate. They were going to go to flat to accelerate to that 10 rate. So what you saw there is, the market starting to broaden, which is good. We like to see broadening anyway, right? To see some other names besides those big 7 or 8 lead the way. But what happened this quarter was the earnings were so good on those top 8 names that I think that help propel the market quickly. That's kind of what the V-shaped recovery is. But that doesn't mean just because they're the biggest, they're going to remain the biggest either. If they start disappointing on their earnings guidance going forward, I think you can see a sell-off. And if those 493 actually do better than their expectations, that's where I think you can see that broadening out accelerate.
Yeah, I would agree with earnings drive price action over the long term. The other thing that I think, we talked about this, I think it was whatever day it was, Tyler, after we had a meeting talking about active versus passive and the flow dynamics, right? It's almost like, earnings do drive the stocks and can change the ordering of those, groupings in the top holdings of ETFs. But it's almost like a flywheel on a like a stationary bike, right? You start cycling and it's a little hard at the beginning, and then once the wheel is moving, even if you stop cycling, the wheel keeps spinning. So there definitely is a momentum dynamic. And I was just curious after that, conversation that you and I had. I went and pulled up like the SPY, VOO, that kind of like S&P 500 index, and then I just took a look at a couple of like the $1 billion AUM kind of ETFs out there, whether it be income oriented, value growth, wide variety, and the overlap in the top 15 holdings or like 80%. So, you look at it's like Nvidia, Microsoft, Apple, Amazon, Meta, Broadcom, Google, Tesla, Berkshire, JP Morgan, Visa, Eli Lilly, Netflix, and MasterCard. And so you look at that and you're like, oh, okay, so like most of those are held even in an income portfolio ETF or a growth ETF or a value ETF. Like it's shocking, the overlap. So it does make me think, okay, there's risk for that, to your point of like, okay, like they're all moving in tandem. And so when correlations snap to 1, when you have a liberation day, like things go down hard. And then when they come back and it eases, to your point, like they all come back, and that's the majority of the returns. But I think the other side of that coin is the opportunity, right? Like the left behind names that aren't in there. And then this is where the earnings growth and some of the like stock specific value drivers work. So like a great example, we already noted it earlier, Dollar General. Like we talked about that just a couple minutes ago, and they're not in, or they're in ETFs, but it's such a nominal amount.
Yeah, they may
It's
be in the bottom 8.
Yeah, the
right, 500.
right. So it's just a small thing. And like another name would be like On Semiconductor, right? They were up 11% yesterday. Cyclical name, beat up. We hold it in Contrarian Choice portfolio as well now. And you look at names like that, and it's like they're not going to be the tide that comes in and they just in that moving, but they can see outsized opportunity in terms of investment because they're kind of like this left behind sitting in a corner name that nobody really thinks about until something happens, where an earnings event happens, or usually it's earnings, but some other kind of idiosyncratic event where it's like, wow, this is, I didn't realize this was here. Why is this moving? Oh, okay. Like, so Dollar General opened up +9 and it closed the day plus, I think, 16. So, people catch wind and that creates an opportunity. So, yeah.
Does it, when you start to see the makeup of the S&P 500, and this is both concentration and regarding the performance as well, is it concerning to see the market performing like it is and having this V-shaped rebound, whether that's COVID, whether that's, 2022 was a little bit different, right? It was a little bit longer tailed event to get back to the highs again. But is it concerning when you start to see performance like this being grouped in these specific names? We had it in 21, 22, or 22, 23, or sorry, 23, 24. It seems like the Mag 7, the big names are the trade to be in again. Is that concerning at all?
I would say yes and no. Just the concentration, right? Just their size, their sheer size is why they're so big in the index.
Yeah.
They're trillion-dollar companies, whereas, Dollar General, these other companies are a lot smaller. So it's, for Dollar General to double, they certainly can do that, if they execute and things like that. And their market, what is it? What their market cap is roughly?
I think it's like 60
billion. Say 60 billion. So 60 billion go to 120 billion. Now flip that, and so Nvidia is over 3 trillion. I think, I think Apple is as well. So that to double, go to 6 trillion, I think it's a lot more work.
Yeah.
So I do think you can get that broadening out just because a law of large numbers, these things can't continue to grow as fast. But in the short period, in the next year or two, if they're going to continue to execute and grow that, 20% plus, where the rest of the rest of the stocks are growing, 5 to 10, I don't think there's any reason why you have to sell them. I think I mean, of those Meg 7 or 8, however you want to classify it, I think you have to, there's ones that you want to own more of and ones you want to own less of. But we certainly don't want those names to fall apart because they are going to, if they make up 25, 30% of the market, if you hoping they sell off, to get value or they execute, that's going to drag the whole market down. Those 493, they would have to do a lot of work to offset that. So in my opinion that be, selective in that, top 8. I think they can continue to, perform well, but then you also need to start picking your names.
So you're saying it's a stock pickers market.
Really? Is that what the show's called? Maybe?
Is
I
it?
don't know. I don't know. So it truly is. I mean, so there's a people's opinion, beginning of the year that you need to sell all these Meg 7, Meg 8 names and just do the rest of the names. But obviously you see these moves like we see recently, you don't want to be completely no exposure to that as well. So,
I mean, okay. So Kyle, answer this. So can companies get to the same size to rival the big guys, or are the private markets, is there an issue with how public markets are structured right now? Because there is so much money and so much interest on the private side, right? I mean, you have so much money going to those private equity type of funds that companies don't necessarily have to IPO anymore.
Right.
So does that create a structural problem for the market where it's going to continue to be this concentrated in these big names because we're not getting those new innovative companies that have historically come through the ranks, like an NVIDIA, like a Broadcom, like a Netflix?
Right.
We're not getting that right now.
Right.
So is that a structural issue? Does that change?
Yeah, that's a great question. I think it is a structural issue. If you look at the number of IPOs over the last like 5 years, historically very, very low. And last year we started to see some green shoots, like kind of at the end of last year where the IPO market was starting to tick up, but still, it's almost like it's stalled since in the first quarter here. So historically, why that matters is because small and mid-cap companies, in terms of like the risk premium, because they're more risky, you should be compensated as an investor to take on, those positions and own them. They haven't really worked for like a decade. And so you look at that and it's, to your point, it's like, what is working? Well, the Mag 7 plus 1, right? So it really comes down to like earnings growth and where it is. And those pockets, as Keith was saying, it's like, okay, they're probably going to continue to work, and because of the scale of them. So that market leadership won't likely last forever. I mean, if you go back to like 1990, the top 10 names, top 30 names, like they're not in there anymore. Like IBM is not in the top. So there will be a rotation. It's just a function of when. And I do think like the IPO market is not healthy, and that is a structural problem. I don't know what solves that. It's probably an incentive alignment. But if it does, if we do see an uptick there, I think there will be a new kind of like renaissance of small and mid cap that will be driving performance. And I think that goes back to the that stock pickers market, right? Like if you can find those small cap names that deliver strong growth prospects, another great name. We now own this in Contrarian Choice. But at my prior shop, we also owned it when it was a $3 billion market cap name, as Builders First Source, right? You find these small names, and from 2022 to 2024, that name went from 2 billion market cap up to 22 billion. And
that's impressive.
Right. So you're trying to find those names that are, a key kind of must-have product, and what they're doing is building roof trusses and floor trusses and stairwells for homes. And you say, okay, well, how do they grow so rapidly? And it's like, when labor is tight and permitting, and you're building all these homes or attempting to build them, all these dollars matter. And so when you look at like the price of a new home, it's like 2,200 square foot home, $50,000 almost is just lumber alone. And if you're manually building these trusses, it's a problem. So outsourcing to a company like Builders First Source, you can actually, who make them offsite and bring them in, and they're all computerized and made, with machines. You're saving a ton of labor, rework costs. There's the people getting injured on the job, up and down ladder time, the waste to bring in more roll-off containers, all that kind of stuff adds up to the cost. And you can save, if you're Lennar or Pulte, a ton of money. So if you're not IPOing names like that, where you're getting these small companies that have a value proposition, it's a problem. So
yeah,
I think it is a structural thing. It was probably super long-winded, but I think the leadership will change. I just don't know when or how.
Yeah, I would tend to agree that it's probably structural. I don't know if, and I think it's been interesting because it made sense when interest rates were so low that private markets were strong.
Yep.
But now that we have 5% interest rates, it seems a little interesting that it's still so strong to go the private route rather than IPO. Just interesting.
I think some of those companies kind of get swallowed up by mid-sized companies as well before the IPO as well. And then whoever's leading them as a private company are probably like, okay, then that's fine to sell it now instead of going through the IPO process.
Yeah.
It's a different way.
Well, there's more flexibility too. Because if you think you're what would be a good, Cargill is like a local one that's, common, but like Anduril, right? Like, you're doing government contracting and defense, that kind of, software stuff. What's the incentive to go?
Stripe's another one, right?
Right. Yeah. What's the incentive to go public?
Yeah. All right. We'll move on. So this is my wait what, because I thought this was really interesting. I did not realize this, but Amazon in 2023 sold more apparel, 52x the next largest retailer.
Wow.
So Amazon sold
That's crazy.
2x what Walmart sold in apparel in 2023. So is Amazon really the place of choice to shop?
It is.
Apparently,
so convenient.
But okay, so before we started this, Kyle and I were talking. Have you ever ordered clothes off of Amazon?
A couple of miscellaneous things, but not much. But I know people that do. Mr. Binger, I know, is a big fan of ordering stuff. I ordered a lot of stuff off there as well. Generally not a whole lot of clothes per se. It's just everything else I order off Amazon. So, but it doesn't surprise me. I mean, I'm the Costco guy, so it's Kirkland. I have no problem buying Kirkland. The nice thing about that, I think one of the questions you also have is ordering online. You're not exactly sure the sizing, stuff like that. Whereas I go to Costco, I'm like, okay, Kirkland brand looks great to me and looks like it's going to fit. That's easy enough. So I think Amazon, people are doing the same thing, and there's a lot of free returns. So it's like, okay, if you order the wrong
I wonder if this number includes, if this is net sales, right? Because you don't know the sizing.
Yep.
So you probably order
two of them,
a medium and a large.
It's the few things I've done. That's what I've done.
Right. And then you return one of them that doesn't fit. So you're doubling how much you're buying. So I guess should have done a little bit more digging on this chart, but I don't know if it's net sales or total or just I think
that's ultimately the convenience of it. And so many third-party retailers now are on Amazon, right? It's like whatever little garment you have, you can just throw it on Amazon and get some traction. And it's like, okay, fantastic, and get some good reviews on it, and people buy it.
I just have a hard time with Amazon, right? Because it's all brands that you have no idea.
Right. You're a Lululemon guy, so we're talking to the wrong guy. How about you, Kyle? Would you buy anything off Amazon?
I've never bought any clothing off of Amazon. Oh, well, we were joking about this earlier. It was like, in general, men are not huge clothing buyers, but my wife, she doesn't buy clothes off of there either.
Mine doesn't either.
But like you, I have purchased a few items from Costco before, and it's great. It's fine, works. So yeah, I don't know. I don't know who's buying all the stuff at Amazon, but it is extremely convenient.
And I'm sure most of the stuff, like Lululemon, does not have any specific IP or anything for the actual stitching or anything like that. It's just a brand.
Well, can you not buy it on Amazon?
Lululemon?
Yeah.
I don't think so.
No. Nikes you can.
But
I've bought shoes.
Right? Yeah.
But I'm sure a lot of the clothing on Amazon probably comes from the same exact factory that
That's the point.
Lululemon pants are made in, but it's just under a sketchy brand that I have a hard time trusting.
No, that's the same as Costco and Kirkland brand, right?
Right.
It's the same
Yeah.
stuff that you're putting a different label on it.
Right.
and
Yeah.
You're
that's
getting
where old guys, cheap guys like me who don't care.
right.
about label.
You're getting Grey Goose with a Kirkland label.
That's exactly right.
Right.
All right,
You know
Keith.
my
So then here's my
secrets.
question for you: Is Amazon is one of your favorite
One of my favorites, and Costco.
stock picks?
Yeah.
And I'm sure it's going to be a pick in the next segment. But what does that mean for Amazon and tariffs?
Yeah, part
Is
of
it
it's
still your favorite pick, even if
Yeah.
we go back to Liberation Day reciprocal
for
tariffs?
sure, because I still think just like your chart shows here, you can't see if you're listening, but it's 2x an X retailer, and when tariffs hit, it's like a tax on everybody, but everybody assumes that the end consumer is going to eat it all, which is not the case. So some of it's going to be by the person selling it, some will be by the people manufacturing, some will be by the consumer. So I think they're all going to share in that cost. And again, if it's a tariff and if you want something, all prices are going to be elevated. So I still think you're going to continue to shop there. Now, people may have a little less discretionary. So that's I think a whole category issue, not necessarily just an Amazon issue.
That's fair.
Mhm.
All right, Spaghetti Wall. So I tried to be somewhat PG with this and do date Mary punt rather than date Mary kill.
Yeah.
So which stock would you date? Meaning you'd consistently trade it, but you're never going to hold it for a long period of time.
Kyle, you want to start?
Yeah, I mean, the names that jump into my mind would be the cyclicals, and a name that you date would be like a Rockwell Automation, where it's like a good quality robotics company. They're making all the stuff that goes into the factories, but if you hold it for a long period of time, you're going to be riding the waves up and down.
Yep.
Yeah, that's a good one. You could tell Kyle's background is a little more value and mine's growth, because I'm going with a name I haven't owned for quite a while, but it would be Tesla. I think that's a growth name that has,
Again, cyclical.
Yeah, I guess you're right. I guess it has multiple pullbacks and opportunities. So it's just lately I've been, the dates got away from me before I could ask her out. So haven't had it for a while.
I went with Toast.
Oh, that's
Payment
that's another
processing.
name I've been looking at for one of the portfolios.
But that thing you can get whacked pretty good on it. So I tried to not ride the highs so high on that one.
Yeah, you're right.
All right. Which stock would you marry? Meaning this is just a long-term buy and hold. You're not getting rid of it.
I'll start because we kind of just touched on two. The two I'd be bringing down the aisle. I'd have to ditch one at the end would be Costco or Amazon. I think I'm going to stay with Amazon.
You're going to ditch Costco?
Well, I mean,
the altar?
at the altar, one of the two. I can't get two cut,
right.
Tyler. So I only have one.
I actually put Costco on my list here too. Yeah, the long-term high quality compounder. The other one would be like a Berkshire.
Can't go wrong with that. I own all three of them, different portfolios.
I'm bringing Broadcom down the aisle.
Was there any question on that?
There's no question.
Hey, but by the way, I think they report this week.
They do.
You think
Thursday.
Good, bad? I
think
there's
it's
a bead
great.
of sweat on him.
I think it's going to be great.
Great.
Yeah.
I like that. Oh, the other one, since you kind of mentioned, I think Lululemon might be this week. Is that true? You got any confident feelings one way or the other?
That one we've talked about this.
I know.
That's
why I brought it up.
So the backstory is if I buy Lululemon before the quarter, because I always like to do that just because it's fun, and if I buy it, the stock's down 5-10%
Of course.
on the quarter.
Yeah.
If I don't buy it, the stock's up 5-10% on the quarter. So
right.
I've given up on.
Good. So we own it around here, so don't buy it.
Yeah.
So stock will go up.
Last quarter was good, wasn't it?
It was.
Yeah. Okay. All right. Which stock would you punt? Meaning, if you had to buy this, it would be the worst thing you've ever had to do.
Kyle, you want to go first?
For me, I would say the name that immediately jumps to my mind is Pfizer. But anything softline retails that are like on the low end, so like a VFC or a Phillips Van Heusen or that kind of thing, they will rip your face off. It's just it's incredibly difficult. People make money in them. They're incredibly difficult for me to invest in.
Yeah, you're right on that. They look like, oh, that's good.
Yeah.
Good from far, but far from good. Or
Right.
One of those.
Totally. Totally. You're like, oh, that VF Corp looks really nice. Doesn't.
I'm going with a name we never talk about, and again, we don't talk about because we don't own it here, but it's been a fantastic stock. So I've been completely wrong. It's been Philip Morris. it's a name that's been, I think I just looked, I think on 1 year numbers, performance is up 85%. The market's around, 15-ish on a one. So it's like certainly missed out, but I don't quite get it. It's obviously it's cigarettes, but it's more than that. It's e-cigs. I think it's 60-40 now. They're split on cigarettes versus non-smoking. So it's just surprises me. The multiple is high. It grows okay, but it just I think it's a trend. Maybe it's the smokeless and people, which I think it's hard for me to get behind, but the valuation just I think is ridiculous. But again, I wouldn't touch it at these levels.
Yeah. Who would I punt? I would generally have to agree with Kyle, like a VFC or.
Yeah, that's a good category.
I mean, I've owned like the LVMHs before, just a high quality,
different business.
Yeah, very different. Or I would say miners is always a hard one to actually get into. So Rio Tinto would be probably a good one.
Yeah.
Yeah, it's another space.
It's just capital intensive.
Yeah.
The stock is extremely volatile. You have to time it perfectly if you're going to get a good return on it.
Right.
So
correct.
All right. Well, like and subscribe, and we'll see you guys next week.